All right, welcome to today's discussion about monetary policy. Let's get out our binder check sheets and we're going to add in monetary policy notes. And this is the last thing you're going to get from me before we do a review. I know you're very excited about that. All right, if you need to pause anytime during the video, please go ahead and do so. All right, so yesterday we talked about the fact that if you went to the mall, you could go several different ways, but you wind up in the same place. That's really the difference between fiscal and monetary policy. It's two different pathways to trying to fix the economy, either through expansion of it or contraction of it. And yesterday we talked about fiscal policy being the president and Congress, or the governor and state legislatures, or the county executive and the county legislature, using taxing and spending to influence the economy. Well, monetary policy is also trying to, a way to influence the economy, either contract or expansion, and it's something that's done by the Federal Reserve. And the Federal Reserve is the central bank of the United States. All right, so monetary policy, basically, I just told you this, is the expansion or contraction of the money supply in order to influence the cost and availability of credit. And there's lots of different ways that they're going to do that. So the Fed has three major, there's a word missing here, ways it can use to conduct monetary policy. And they're all based on the reserve system. Okay, so the first thing that we need to talk about is fractional reserve banking. Banks and other financial institutions must keep a fraction of their deposits in the form of legal reserves, and legal reserves, for example, are the currency and the coins of that country. And obviously, as we've talked about in previous chapters, that's the dollar for us. And the required reserve ratio is the percentage of every deposit that should be set aside as legal reserves. So, for example, the reserve requirement today is roughly 3%, but let's take an example and pretend it was 2%. What that means is if somebody deposits $100 into a checking account, let's say it's 12%, $12 must be set aside as vault cash or kept as a deposit at the Fed. So they're holding money back. The other 88 they can use for loans. So if they wanted to make the bank have more money on hand, they would lower it. So it'd be like 8%, and then they can loan out $92. Or if they want to have the bank have less money on hand, then they are going to, or to loan out, then they would raise it like to 15%, and then they could only loan out $85. All right, so yesterday we talked about expansionary and contractionary fiscal policy. Same kind of thing. We have easy money policy, which the Fed allows the money supply to grow and interest rates to fall. So this is expansionary. Whatever is going to do to make it easier for people to get money in their hands, because as we know, they spend money. So if they want it easy for people to get money, they would lower the required reserve ratio, right, because that means the bank can lend out more money. They would lower interest rates, because if there are lower interest rates, people are more willing to borrow money, and banks are more willing to borrow money from the Fed. We can't borrow money from the Fed. We have to go to our normal bank to do that. This stimulates the economy. Low interest rates, as I was saying, more people are buying on credit, businesses tend to borrow more. All of that is going to help stimulate the economy. So that was easy money policy, otherwise known as expansionary policy. The next one would be tight money policy. And this, the Fed restricts the growth of the money supply. So if the economy is growing way too fast, then they want to slow that growth. They're going to restrict the growth of the money supply, and interest rates are going to increase. So for an example, they would raise the required reserve ratio. They would raise interest rates. So that means that banks can't lend out as much money, and if they raise interest rates, people are less willing to borrow money, slowing the economy down. So let's review. The first tool in working with the economy that the Fed has is the reserve requirement, which we just talked about. The second tool that they have is open market operations, and this is a little confusing, not gonna lie. This is the buying and selling of bonds. All right, so for example, and you have to look at it as a transaction between the Federal Reserve and your local bank. So if the Fed sells bonds to the bank, all right, then the bank is going to have less money. And if they have less money, they can't loan it out as much. So that would be tight money policy or contractionary monetary policy. If the Fed buys bonds, then the bank will have more money. So think of it this way. If you think about it, if you are buying something, you're giving up money. Okay, and if you're selling something, you are getting money. So the bank, if the bank has less money because they bought bonds from the Fed, then they have less money to loan out. If they are selling them back to the Fed, then they have more money and they can loan that money out. And so when the Fed sells bonds and banks will have less money, that is tight or contractionary monetary policy. When the Fed buys the bonds, the bank will have more money, and that is going to the banks can lend out more money. All right, so that was the second tool. The third one is the discount rate, and this is the interest rate that the Fed charges on loans to financial institutions. So if they raise the discount rate, now this is kind of counterintuitive to what you think of when you think of a discount, because if you think of a discount that was 25% and it got raised to 50%, that's saving you more money, but that's not how this works. So this would be if you raise the discount rate. So let's say that the discount rate is 0.25%. If they raised it to 0.45%, that means that the banks would have to pay more interest on the loan that they are borrowing money from the Fed, and they're less likely to do it. So an increase in the discount rate is going to be tight money policy, and a decrease in the discount rate would make it so that it's cheaper for the banks to borrow money, and thus that is easy money policy, or expansionary monetary policy, excuse me. Okay, so here's what's going to happen. I am going to explain to you how to do this section. You are going to pause it, then you are going to complete it, and then you're going to start the video up to check how you did. Please be honest about that. Don't just sit here and wait for me to fill it in for you. So you are going to talk in this 1, 2, and 3 about expansionary monetary policies. All right. So for example, in expansionary monetary policy, do they raise or lower the reserve requirement? So I'm going to do this one for you. For example, they're going to lower the reserve requirement. And in contractionary monetary policy, they are going to increase the reserve requirement. So for number 2, would the Fed be selling or buying bonds in expansionary monetary policy? And contractionary monetary policy, would the Fed be buying or selling bonds? And then you need an arrow for increasing or decreasing the discount rate for expansionary monetary policy and contractionary monetary policy. Then, when you get down to the bottom, you want to choose, is it fiscal or monetary policy? And these are all examples of expansionary. These are all examples of contractionary. You just have to figure out if it's fiscal or monetary. So, for example, lowering the interest rate, that's something that the Fed does, so that's something that's monetary policy. All right, so you want to do M's or F's all the way down in both of those columns. All right, so hopefully you understand what you're doing. Otherwise, rewind, listen to the directions again, pause it, write your answers down, and then check them. Okay, welcome back. Hopefully you said that in expansionary monetary policy, the Fed is buying bonds because then the bank has more money. And in contractionary, they are selling them. In expansionary monetary policy, they're going to lower the discount rate because they want an incentive for the banks to borrow money. And in contractionary monetary policy, they're going to raise the discount rate because then the banks are less likely to borrow money, thus slowing the growth of the economy because the money supply is shrinking. Expansionary, fiscal, or monetary. So we already talked about the fact that interest rates are monetary policy. Increasing federal or government spending. hopefully you said that was fiscal. Increasing aggregate demand, hopefully you said that was fiscal. Lowering taxes, hopefully you said that was fiscal. And easy money policy, hopefully you said that was monetary. And then they should be the same letters over here because they correspond. So government spending, fiscal policy. Aggregate demand, fiscal policy. Raising taxes, fiscal policy. Tight money policy, monetary. All right, and that is monetary policy in a nutshell. All right, so make sure that you read the directions for today. I hope you have a great rest of the day. Enjoy your weekend, make smart choices, and don't outsmart your common sense.